Radio for a really great future. We're talking real money.
It's another day for Q&A. Hey, hi, welcome to Talking Real Money. I'm Don McDonald, the host of the Friday Q&A edition of the program. This is the show where I take the questions that you send in at talkingrealmoney.com by speaking them into a microphone, and I try to answer them on our little podcast. So glad you sent in questions. We don't have nearly as many today. I'm having to kind of spread them out. It's summer, and we've kind of gotten into the slow season for recorded questions. It's funny. It is the slow season. Summers are slow. Our download count drops over the summer. I looked back at charts, and it's every summer from June to mid-August. Every single year, the number of downloads declines because people are doing other things over the summer. We become like a different country in the summer. We don't work as hard. This could be why. I'm going to speak very generally, but think about it for a minute. The northern states are kind of known for higher levels of productivity. All of these giant corporations are based in the northern part of the country. You look down in the south and you go, no, just not as many. And I think that's because down here in the south, we have a longer summer. It's kind of nicer for longer, or at least temperate. You know, when it gets really cold, you just want to go in and work. And we don't get cold down here. So let's move on to those questions, shall we? These were sent in at talkingrealmoney.com on the contact form, and they were recorded with your mic on your computer or on your phone kind of product. Here's the first.
Hey, Don and Tom. For the first time in a long time, I listened to Suze Orman's podcast today. And she's mentioning, because of the instability in the United States, and she mentioned war, that she's getting out of treasuries and instead buying dividend-paying stocks. She gave as an example buying Pfizer. This to me seems like apples and oranges as far as, trading something that's sort of a fixed asset for a stock. I just wanted you guys to weigh in on this one. Thanks for all you do.
Well, this is... in the memorable words of Boston Globe financial columnist Chuck Jaffe, who was once on the show, one of the many reasons
why I hate Suze Orman.
I don't know why I kept that. I just loved the bluntness of it. I kept that audio clip for years. That is actually Chuck Jaffe from an interview I did a long time ago. And he hates Suze Orman. I hate her advice. I think the vast majority of her advice is so simplistic and practically worthless. Was she another friend of Oprah's? I'm not sure. I don't know. I don't know where she came from, but her advice is just pedestrian. And dumb. This is just dumb. This is terrible advice. Dividend-paying stocks are not substitutes for Treasury securities. They can't even begin to approach the security of Treasuries. Apparently, she doesn't even know what Treasuries are for. They're for relative safety and relative stability. Pfizer is really, truly, or any other company, is neither of those. She's saying that a pharmaceutical stock is safer than the U.S. government? Is that what her implication is? Why? I don't understand why anybody listens to Suze Orman. I can see. Okay, Chuck, I get it. I can see
why I hate Suze Orman.
And thanks for your question. If you'd like to ask a question or send it in or talk it in or call it in or whatever it is that you do with it, just go to talkingrealmoney.com, go to the contact button in the upper right-hand corner, and you can type it or you can speak it. And I need the spoken ones more than I need the typed ones. Tom's got like 30 typed ones, and I'm going to run low of the spoken ones here in a few weeks. So call those in at talkingrealmoney.com or call us on Saturdays. Every Saturday from 3 to 5 p.m. Eastern Time, we do a show on Northwest News Radio in Seattle, And you can call that show and talk with us. And then that becomes a podcast later. So either way it works. Just send in your question and we'll answer them on one of the shows like this one.
Hey, Tom and Don. I have a couple of questions, actually a two-part question about the 4% rule. Wondered if you could take a shot at it. Definitely a loyal listener, been listening for a couple of years now, and I really enjoy your show, your approach to your show and how you handle everything and the questions that you take. So I definitely appreciate all you guys do. So my question has to do, like I mentioned, with the 4% rule. The first part of it is, I assume, the way I understand the rule is, you take 4%. Let's just say, hypothetically, as an example, I retire at 65. I have $1 million, and using the 4% rule, I take $40,000 a year, adding colas, etc., as I go. In that example, does the 4% rule, 30 years from then, let's say I'm lucky enough to live to 95, does the 4% rule then assume, or I guess does the math assume then at that point that I would run out of money at 95? So, I'm taking 40,000 plus the colas every year. I am, 95. Does that assume that $1 million then is pretty much gone? I mean, I know there's a lot of variables that go into that, but just in general, is that what that 4% rule is saying? So that's the first part of my question.
Okay, let's stop right there. We'll stop at the first part of your question, because this is one of the things I like is I can split the question up because we kind of forget the first part when we get into the second part. So let's focus on that first part because that's really important. Any of these rule of thumb calculations are based on some assumptions, and the 4% rule is based on a portfolio allocation assumption, and that is a portfolio that is 60% U.S. equities and 40% fixed income investments, generally the S&P 500 and aggregate bonds, a stock bond portfolio of 60-40. It has worked very well with a 60-40 portfolio because over a long period of time, the 60-40 portfolios have averaged a return of about 7% per year, give or take. So that means you could take 4% out plus the inflation rate every year because your portfolio is overall more than keeping up with the withdrawals. So you should never run out of money. But, of course, we're basing our assumption on the past. We have no idea what the future is going to look like. So based on the past, you would not have run out of money using the 4% rule. Going forward, of course, we don't know, but we think it's a reasonable starting point. There are various other ways, though, to do it. It's just a rule of thumb. But no, you should not run out of money in 30 years. Now,
the second part has to do with return. So I took your risk quiz. I'm a bit risk averse, and I think I'd feel more comfortable at like 50-50 stocks and bonds and, something like that anyway. Just curious how that would affect that 4% rule in general terms. I know you can't be too specific on that, but, would I need to dial that back to 3% or is there kind of a rule of thumb with that? So just wanted to get your thoughts on that. Appreciate it. Thank you for all you do.
thanks for listening and thanks for the question. And you're in good shape. I mean, if you're more conservative, again, the 4% rule is not our favorite. We like a flexible withdrawal, and I think you could do a 5 flexible even with the 50. I know you could have in the past. I ran the numbers with just the S&P 500 and just the aggregate bonds, the intermediate bond portfolio like BND. And over the last 30 years through 2024, the 4% rule on $1 million would have generated, starting with 40,000, and then it would have increased over time to, by today, that 40,000 withdrawal would be about $86,000 based on the inflation rates over that time. But you know how much money you would have had in your portfolio over that period of time? Starting with $1 million, adding nothing, taking out the amount based on the 4% rule. The amount in the portfolio is almost $3.5 million. See? So you can be pretty conservative. As long as you have a disciplined approach, generally we find that disciplined approaches work. If you just willy-nilly take the money out when you want, you're not paying much attention. Oh, by the way, this also requires rebalancing to maintain that portfolio allocation over the 30 years. But you see, at the end of 30 years, if you have that kind of a discipline, it has been very hard. As a matter of fact, it's been impossible to run out of money in almost any scenario. I mean, we could come up with a far-fetched scenario where you got in at the absolute worst possible time and you were taking distributions at the wrong times or whatever. But generally speaking, we get no guarantees in life, not even from insurance companies. You're going to be in pretty good shape with the 4% rule. Thanks for your question again. I appreciate it. And if you have questions, go to talkingrealmoney.com, send them in, or call us on Saturdays at 855-935-TALK. Let's do another one.
Hey there. This is Lucas here in North Carolina. I was hoping you could help me think through some things with my taxable brokerage account. My wife and I are both 34 years old and have one kid that's a year old, and we'd like some thoughts on any pitfalls or considerations as it relates to growing and then using a taxable brokerage account to supplement income before retirement. We make about $315,000 combined gross salary before bonuses, but one thing we would like to focus on over the next couple of years is growing our taxable brokerage account so that we can take our feet off the gas and maybe shift into a different career within the next 10 to 15 years. Here are our financial details. Our finances are fully combined. We own our house that we have fully paid off in 2024, so no mortgage and no HELOC associated with it. We own both our cars full and clear. We have about $600,000 split between traditional and Roth retirement savings, $10K in HSA, $15K in 529, about $30,000 in company stock, and about $40,000 in emergency fund. And our taxable brokerage has about $170,000. The retirement accounts at this point are just about 6% per paycheck, so we can get our employer match. Brokerage account is invested in low-cost S&P 500 index funds, and we're able to put away about $70,000 to $90,000 per year at our taxable brokerage. Our yearly expenses are usually around $80,000, but with daycare costs and other baby expenses, we're expecting it to be around $100,000 to $110,000 for the next few years. What are some things we should think about and take into account as we continue to pad our taxable brokerage so we can ease off or make a change? I'm not too sure about the process of taking money from the taxable brokerage when it's time. Obviously, we'll start to get more dividends and capital distributions and may need to pay quarterly taxes to keep from owing Uncle Sam more than expected at the end of the year. But outside of that, what is there? Is it as simple as building up the account as far as we think we need to and then drawing down what we need to take care of expenses? Thanks for the help. And please keep up the good work on the show.
Thanks. It's not like you have to work very hard there. Holy cow, you guys are doing well. You can live on 110. You're making 315. You're putting money in your retirement plans. You're putting money in your taxable brokerage account. I saw one hole in here, just one, your emergency money. I think you really should pad that out some more, given I would probably get that. Given your current expenses, I'd probably get that up to about 50 or maybe 60, just to be safe. But no, you're doing great. Just keep building that taxable brokerage account. However, I think you could invest it a lot better. Well, even just a little better, as opposed to being in the S&P 500. I would rather see you in a total market fund like a VT or in an AVGE or a DFAW to give you much broader diversification in your 30s when you can afford to be aggressive. I would certainly broaden that. I really would. I think you're too focused on the biggest blue chip stocks in the U.S., and you need the smalls, you need the values, you need a tilt. You got to have that. So I would make that change, and then when it comes time to take it out, right now you're reinvesting the dividends, and you still pay taxes on those dividends. but you're reinvesting the dividends, and that's building your wealth. When you start to take money out, the first money you can take is just take those dividends. You're already used to paying taxes on them. You take those dividends, and then if you need a little more every once in a while, you liquidate some of the securities, and you realize a capital gain, which will be taxed at a lower rate than your income. But that's way down the road. The trick is now, get it as big as you can get it, because then your flexibility increases dramatically 10, 15 years down the road if you want to make a career change. But you guys are doing so darned well. Congratulations. Now, today's final question. Send in at talkingrealmoney.com on the contact form.
Hello, Don and Tom. This is David from the Yosemite area, and I just got some kind of spam email that I clicked on, and it turns out to be Bob Carlson spewing on and on and on about some new law Congress just passed, Senate passed, and he said that Trump has already signed into law that's going to devastate Americans' retirement plan. He goes on and on and on for 20 minutes at least, never mentions what this new law is or the specifics of what this law is going to, or how this law is going to devastate all Americans' retirement plans. Do you know what he's talking about, or is he just spewing BS? It's been great listening to you over the years, and just let me know if this is total BS or if there's anything to it. Thanks.
Total BS? I hate to call anything total BS. Even indexed annuities aren't total BS. But there's a whole lot of BSing going on here, and it's really difficult to discern the ultimate motivation, but we can reasonably assume that Bob Carlson's motivation somehow comes through remuneration from somebody in the insurance industry. That's my guess, just given what he's hawking. Because he's basically saying you should get out of your IRAs, you should take all your money and put it in permanent life insurance. In other words, whole or universal life, which makes people who sell the product incredibly wealthy and generally stinks for the people who buy it. You get pitiful returns and no added tax advantage to your retirement accounts, and if you take all your money out of IRAs, you're going to pay a ton in taxes. It's just really terrible advice, every bit of it. Now, he also makes money selling coaching and newsletters and memberships and that kind of stuff. But is it anything anybody anywhere should pay any attention to? No, it's ludicrous. And the smart thing from Bob's perspective is the fact that he's doing it in the insurance industry, where regulations are so lax and so opaque or non-existent that, unlike the investment advisory business, where if you are getting kickbacks from investment advisors for recommending things that they do, you have to disclose those. In fact, you have to be registered. In the insurance business, they can give people money for almost anything, and nobody has to disclose anything. And it is the Wild West, and it is appalling. Most of the business, I think that most of the investment insurance business that is done in this country, I believe is done nefariously. I'm trying to think of a good word. Nefariously works really well. It's not on the up and up. It may not be illegal. In fact, it's not illegal, but it's not good. It's not good for you. And I'm appalled at the industry. I find myself on an almost daily basis appalled. In fact, just recently, Tom talked with a guy who's a financial advisor, and he has a radio show in a small market. And there are 5 other shows on that same radio station. Now, the one guy he talked to is a true registered investment advisor who acts as a fiduciary all the time, like us. The other 5 shows, I looked them up. Every one of them was either strictly an insurance investment seller or was a registered investment advisor who was also licensed to sell insurance and disclosed that in their Form ADV Part 2. The problem is no one reads the disclosures, the disclaimers, and people get sold garbage by the insurance industry, utter garbage that makes the people selling them lots in commissions. And by the way, these commissions are not required to be disclosed like they are in the brokerage industry or the investment advice industry. They don't have to disclose them. This is a bad system for consumers. Not likely we're going to get any changes in the not too distant future, but it's a bad system for consumers, and it puts the onus on you. Another Don diatribe here at the end of a podcast episode. You've got to take care of you. Bob Carlson's not going to take care of you, and I would definitely not subscribe to his stuff. But I'm sure he's doing really well pushing permanent life products and probably, I'm just guessing, getting some big checks for suggesting them. Just guessing. Not saying. Don't know for sure. No way to find out. No disclosure required. Thanks for all your questions, and please go to talkingrealmoney.com, hit on that contact us button up in the corner, and record your questions using a mic. Get a mic for your computer or use the really good mic on your iPhone. iPhones have great mics, by the way, great mics. And ask your questions because I love answering them. And you know what's funny? Our listeners love hearing them. It's consistently the Q&A shows are among the most popular. So do that. We'd appreciate it. If you get a chance, tell a friend or two about what we do. If you would like to get some help from a true fiduciary advisor who will never, ever, ever, ever try to put you into an indexed annuity or permanent life, go to talkingrealmoney.com and click on Meet an Advisor to set up an appointment with one of our Appella advisors. And this is not your typical consultation appointment. Nope. We help anybody, anyone, anywhere who asks us for free. No obligation, no high-pressure sales pitch. Heck, you can even meet with Tom. So just go to talkingrealmoney.com, click on Meet an Advisor, and please listen over the summer. Get some other people. You're hanging out with family and friends over the summer. Have you told them to listen to Talking Real Money? If not, turn it on around the campfire one night. Tonight, bedtime money stories with Talking Real Money, or something like that, and help us out. Thanks so much. Take care of yourselves. I'm Don, here regularly and every Friday, answering questions and talking real money.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.
Tipping culture is out of control. Yesterday, I tipped someone just for handing me a napkin. So when Hotels.com gives me up to 20% off for being a member, I finally get tipped. And you know what? It feels good. Hotels.com. Members save up to 20% off at hundreds of thousands of hotels.